Our Italian tax system is nonsense, period. And this is what I hear from people approaching our rules for the first time as well. For expats who must account for worldwide income, foreign assets, international agreements, filing a tax return in Italy is not just about listing numbers on a piece of paper. It requires expertise, precision, and a real case by case approach to compliance. Filing a tax return in Italy requires you, as you know, to declare your worldwide income, whether earned in Italy or in other countries, so Italian servers or abroad. And for expats, this process is compounded by income from multiple jurisdictions, such as salaries, dividends, rental income, foreign assets for the wealth tax purposes, such as bank accounts, investment, retirement accounts, properties, etc. And of course, then you have to apply the dual taxation. As you know, all around the world, Italy signed several hundreds dual taxation agreements to avoid dual taxation. The main principle is you can credit all the taxes paid in foreign countries. So the right application of the tax treaties is essential to avoid the dual taxation. You have to start filing by your personal identification number, residency status. So your codice fiscale, your Italian tax code, proof of your Italian domicile tax residency, determine, spending more than 103 days in Italy, registration to the municipality, or generally speaking, proving the center of interest for the majority of the year. Regarding then the income generated abroad or in Italy, the list is pretty long. Just to name one, you have to include unemployment income, so salaries, wages earned both locally and abroad, rental income, properties here and outside of Italy, business income, so profits for self-employment or partnership or investments in companies, and of course, pure investment companies such as dividend, interest, and capital gains for investments. One of the painful part of filing your Italian taxes is led by the RW framework for the wealth tax purposes. It is mandatory for declaring foreign assets, and it covers, as I said, bank accounts, real estate properties, cryptocurrencies, retirement, and investment accounts. How to avoid the dual taxation? Well, first thing first, you need to prove your taxes paid abroad. And then, of course, you have to get all the documentary evidence regarding the justifications and all the taxes paid abroad and the sources of income. So income breakdowns by average jurisdiction. Let's pick an example, okay? Elizabeth, a US freelancer living in Rome, and she earns income from US clients and holds investments in a US brokerage account. In her case, she has to declare her freelance income in Italy, even though her clients are not resident of Italy. She has to report the brokerage account in the US and the gains resulting from the brokerage account in the RW and RM framework, the RW for the wealth tax, the RM for the capital gain tax, and why not applying the US and Italy dual taxation treaty to claim credits and taxes already paid abroad. Something that I hear very often from clients is why foreign income is not just a copy and paste if numbers are numbers. It's a lovely question. Income earned abroad cannot simply be transferred into the Italian tax return because, for example, there is a different classification, there is a different tax treatment, and different deductions depending on the income type. For example, rental income is different from dividends. The country of origin, the source country, because tax treaties can use different words and they can influence how income is taxed. And then the last one, currency convention. The income must be reported in euros with correct exchange rates applied. So each case requires a really careful analysis to ensure compliance and fairness, because no one knows to pay more than what is due. What are the challenges that almost everyone has to deal with? Well, the complex foreign asset reporting. The RW looks like a mix of different codes to pick, but fines are up to 30% of the undeclared asset value. And of course, there are retroactive audits and penalties if you skip that. And they can go back in time 5 to 8 years. there are dual taxation missteps, because the dual taxation can be possibly generated on the same income, and it's up to you to prove that you paid some taxes abroad. And of course, consequently, missed credits for taxes paid abroad is on your charge. A lot of people wonder about the global transparency standards, the common reporting standards. As you know, financial institutions starting from the late 80s share account information with Italian authorities. So, in 2 words, they know. And if you skip something, more likely you will be flagged. Filing a tax return is very close to a compliance task. It's more like a strategic process. And the fiscal obligations, as you know, are not just paying taxes or filing taxes. You have to start from scratch, analyzing your income and assets, really case by case, optimizing the use of the tax treaties to minimize liabilities, and to see if, for example, a certain taxable income is considered taxable as well in Italy. And don't forget about this. Avoid penalties, meet the deadlines, file every single framework. The ultimate goal here is fairness. This is the key word. Paying the right, correct amount of tax. Nothing more, nothing less.
At studiorigo, we provide world-class tax and financial guidance for expats and international professionals in Italy. We don't just help you stay compliant. We craft strategic tax solutions tailored to high-level individuals who demand precision and expertise. If you are serious about optimizing your tax position, visit our website or connect with us on social media. We work with those who value excellence, and we look forward to assisting you. Thank you for watching. See you in the next video.